I recently met an architect who was obsessed with the idea of a glass house. Not for himself, mind you, for everyone else. He spoke about the digital euro with the kind of reverence usually reserved for a religious awakening. Imagine, he told me, a world where every cent is accounted for. No more tax evasion, no more black markets, just pure programmable efficiency. He showed me a mock-up on his tablet, a digital wallet capped at exactly 3,000 euros. It's for the public good, he insisted, his eyes gleaming. Complete transparency. But then I asked him a simple question. Does the glass work both ways? The enthusiasm vanished. He started fidgeting with his stylus. I mentioned a certain 35 billion euro vaccine deal negotiated entirely via text messages. Messages have somehow evaporated the moment investigators started asking questions. I brought up the European Parliament members who receive 4,000 euros a month in expenditure allowances deposited directly into their accounts with zero receipts required, or the literal suitcases of physical banknotes found at a Brussels apartment during the Qatargate raids. Suddenly, the man who wanted to track every cup of coffee you buy became very quiet. He muttered something about administrative complexities and different standards for institutional stability. It was a jarring shift. One moment he was championing a future where your money is programmable, traceable, and restricted. The next he was defending a system where billions of euros simply vanish into the fog of material error. It made me realize that this isn't just a technical upgrade for your bank account. It's a vision of a world where transparency isn't a window, but a one-way mirror. They're building a system that can account for your last 3 euros, yet somehow loses track of its own last 3 billion. It's the most honest proposal in the history of finance, not because of what it promises, but because of what it reveals about who is really in control.
Right. And following that opening, the mission of this deep dive is to examine this exact initiative, the European digital euro, in uncompromising detail. We are going to take the official promises, the convenience, the privacy, the economic efficiency they're advertising, and contrast them directly against the profound legal, technical, and societal critiques.
Yeah.
We're talking about mass surveillance, programmable money, and the absolute erosion of public trust. We really need to dismantle this architecture layer by layer to see what it means for your financial autonomy.
Absolutely, because when you start looking at the individual impact, I actually heard about a woman named Elena. She's a freelance researcher living in the shadow of the European Parliament in Brussels. Yeah. And she was the type of person who really believed in the system, right until the system became a ledger she couldn't erase. Right. So when the digital euro was first introduced, she actually embraced it. She bought into the whole privacy by design promise, and she was using it to fund her small investigations into institutional lobbying. But one afternoon, she's sitting in a cafe in Place du Luxembourg, and she bought a simple meal for a whistleblower,
okay,
a guy involved in a high-profile procurement scandal. This is exactly the kind of meeting that usually leaves no paper trail. Okay. But months later, during a routine compliance check for her credentials, a digital flag appeared.
Ow.
Yeah. And it wasn't that she'd committed a crime. It was that the programmable nature of the currency had automatically mapped her transaction history against high-risk social nodes. The anonymous digital cash had a memory much longer than any physical banknote. And she realized then that in a world of traceable currency, there is simply no such thing as a private conversation if a coffee is involved.
Because in a traditional cash environment, that transaction is functionally invisible. I mean, the exchange of physical notes represents a localized, entirely unrecorded settlement between two private parties. Right. But within the framework of a central bank digital currency, the architecture of settlement is inherently observational. Elena was operating under the assumption that the privacy by design marketed to the public meant actual operational anonymity, like physical cash.
Exactly. And that assumption proved devastating. Looking at Elena's situation, I can't help but feel the weight of that irony. I mean, on my channel, I often talk about how the digital euro is marketed as a tool for autonomy, but this story highlights the terrifying thinness of the line between public safety and total transparency.
Yeah.
While it's easy to dismiss these fears as right-wing paranoia, we really have to acknowledge the legitimate anxiety that comes when the state becomes a silent partner in every single transaction.
Sure.
From a policy standpoint, look, we understand the need to combat corruption and money laundering, especially after the shocks of Qatargate.
Sure.
But when the technology itself becomes a tool for guilt by association, we risk turning every citizen into a permanent suspect. It's a delicate balance, and right now, the scale feels like it's tipping heavily toward the watchers.
Does. And the official stance on privacy, especially heavily promoted by key figures like Fabio Panetta at the European Central Bank, It actively contradicts the reality of Elena's situation.
Completely.
Because the ECB continually pitches the digital euro as this fundamental public good. A state-of-the-art payment solution, they claim, is essential for maintaining European monetary sovereignty. And the core of their argument rests on the explicit claim that the ECB will not have access to personal data.
Right. They propose a system where privacy is supposedly preserved by default and by design.
And to achieve this, they plan to use pseudonymized data structures. Specifically, what they call digital euro account numbers, or DEANs.
DEANs.
Right. And the institutional argument is that these DEANs give you, the user, absolute control over your payment data. They claim it separates your immediate identity from your transactional history. Furthermore, they heavily emphasize that offline payments will offer cash-like privacy, suggesting a digital replication of actual physical coins and notes.
But the necessity of examining those claims against the underlying legal and technical frameworks, it's paramount. Because when you look at the official analysis provided by the European Data Protection Board and the European Data Protection Supervisor, a glaring contradiction emerges immediately.
Yeah, it falls apart.
The entire digital euro framework, specifically within Article 37 of the proposed regulation, relies entirely on this concept of controllable anonymity.
Which is a legal and technical oxymoron. I mean, anonymity, by its fundamental definition, implies an irreversible unlinking of identity from action. It cannot be controllable. The exact moment a central authority, an institution, or even a localized intermediary holds the cryptographic or legal key to revoke that privacy, the system ceases to be anonymous. It just becomes pseudonymized.
And pseudonymity is not a shield. It is just a mask held in place by the tolerance of the state.
The exact public trust this design aims to build is undermined instantly because privacy under that Article 37 framework is completely revocable by the governing institution at their discretion.
And this inherent fragility extends directly into their claims regarding offline use, too. The promise of cash-like privacy for offline transactions is functionally broken at the deepest architectural level.
Yeah, let's talk about the device IDs.
Right, because the regulation strictly mandates the retention of the identifier of the local storage device. This means that when you execute an offline transaction, say, you tap two phones together without an internet connection, this specific peer-to-peer transaction data might not be routed through a central server in that exact moment. However, the system creates a permanent direct link between your Know Your Customer, or KYC identification, and the specific hardware device ID used for those offline exchanges.
And that permanent linkage is the fatal flaw for any claim of anonymity. Because the moment your device inevitably connects to a network, which it must do eventually to either fund the digital wallet or defund it back into a traditional commercial bank account, the system logs all those transactional inputs and outputs.
It just syncs it all up.
It synchronizes all the data. By creating and maintaining this permanent link between your verified identity and the persistent device ID, transactional anonymity is destroyed completely. You are subjected to total usage tracking, which effectively eliminates the exact offline privacy that Article 37 claims to protect.
The data footprint is permanent. It's just waiting for synchronization to become visible to the overarching ledger. And the mandated data retention policies required by this framework further violate fundamental privacy principles established within the European Union itself.
Oh, the 5-year rule.
Yeah. The proposed regulation strictly requires institutions to save all funding and defunding data for a period of 5 years. This mandated retention includes the account numbers, the transactional amounts, and those persistent device identifiers we just discussed.
And this is where the European Data Protection Board steps in, because they explicitly argue that this 5-year retention mandate directly violates the GDPR's storage limitation principle. The foundation of modern European data protection law rests on the necessity and proportionality tests. Imposing full traceability and an arbitrary half-decade beta retention period for low-value, routine offline transactions, it fails both of those tests spectacularly.
Yeah, it represents an excessive, structurally embedded invasion of privacy in everyday situations where the actual risk of money laundering or terrorist financing is statistically minimal. I mean, the regulatory consensus across the financial sector has historically supported a risk-based approach. Surveillance and data collection must align proportionally with actual measurable risk.
Exactly.
Logging every minor digital transaction, every coffee, every transit ticket, every peer-to-peer exchange for 5 years creates a disproportionate, permanent link between your account identifiers and your personal identity for entirely routine behaviors.
And what makes this architectural choice particularly striking is the glaring failure to implement genuine privacy-enhancing technologies. We have robust, mathematically proven systems available today.
Like zero-knowledge proofs.
Yes. A zero-knowledge proof is a cryptographic method that allows one party to definitively prove to another party that a specific statement is true without revealing any additional information beyond the mere fact of its truth.
So it provides absolute verification without data extraction.
Exactly. In a transactional context, it allows a system to verify that you have sufficient funds and that the transaction is valid without the system ever knowing your identity, your balance, or your transaction history. We also have blind signature cryptography, which is a technology successfully utilized in systems like GN-Taylor.
Right.
Blind signatures provide absolute mathematical guarantees of payer anonymity. The governing institution signs off on the validity of the digital token without ever seeing the token's serial number or linking it to the user requesting it. But the European Central Bank has deliberately chosen not to use these established technologies. They have actively opted for a system architecture based on institutional promises and revocable policy settings rather than relying on mathematical certainty. Privacy in the digital euro architecture is merely a setting on an administrative dashboard. It's a dial controlled by the institution rather than a locked cryptographic guarantee.
And this deliberate architectural choice brings us perfectly back to the concept of the one-way mirror, which completely defines the structural reality of the digital euro.
Right.
The digital euro features military-grade encryption, exhaustive full traceability, and real-time auditing capabilities. Every online transaction is designed to flow through a centralized infrastructure known as the Digital Euro Service Platform. These are incredibly powerful precision tools designed for tracking vast financial flows with zero latency. So the critical analytical question we must ask is, what happens if we take these exact powerful tools of full traceability and real-time auditing and point them directly upward to the public institutions designing them?
Well, impartially presenting the documented public sector issues reveals a staggering systemic asymmetry in how transparency is applied and enforced. I mean, consider the findings of the 2025 Follow the Money investigation.
Massive.
This comprehensive analysis involved journalists operating across more than 20 European Union countries, and the investigation revealed that 163 out of 704 sitting European Union lawmakers had been officially involved in scandals, fraud, or theft.
That's almost 1 in 4 active members of the European Parliament.
Exactly, 1 in 4. The report detailed 253 separate documented affairs covering widespread corruption, organized fraud, theft of public funds, and severe workplace harassment. And these actions were undertaken by the exact legislative individuals who are actively shaping the rules, privacy boundaries, and operational constraints of the digital euro framework.
And add to that systemic issue the specific case of the Greek organized crime network. Over a period of 5 years, this extensive network utilized false land and livestock declarations to systematically steal over 1 billion euros in European Union agricultural subsidies.
€1 billion.
Yeah. The operation resulted in 37 arrests and directly implicated 2 former rural development ministers. Now, if the European Union operated entirely on the proposed digital euro framework, every single one of those fraudulent subsidy payments could have been tracked from Brussels to the final recipient in absolute real time.
Right.
The technology to automatically verify every company's corporate registry existence and mathematically cross-reference every agricultural declaration before a single euro is released, that is exactly the back-end infrastructure currently being built.
And we must also examine the documented events surrounding Qatargate, which profoundly shocked the European establishment. During those police raids, literal suitcases packed with hundreds of thousands of euros in physical banknotes were found in a Brussels apartment belonging to high-ranking parliamentary officials.
Literal suitcases of cash.
Literal suitcases. But alongside this explicit corruption, we must observe the daily operational mechanics of the parliament itself. European Parliament members currently receive expenditure allowances of over 4,000 euros every single month. These funds are deposited directly into their personal accounts, and the institution requires 0 receipts for auditing purposes.
Right.
The funds simply vanish into discretionary spending without a single trace.
And finally, there's the highly documented case regarding the 35 billion euro vaccine procurement deal. This massive allocation of public funds was negotiated almost entirely via private text messages by the Commission president. And the critical issue is that those exact messages were subsequently deleted. They evaporated into the digital ether, the precise moment institutional transparency was legally requested by investigative journalists and oversight committees.
So the double standard becomes remarkably stark when you look at the strict limitations applied to you, the everyday citizen. The digital euro framework proposes a strict €3,000 holding limit per individual. The general public is subjected to this hard cap, combined with detailed spending categorization and real-time transaction monitoring by supervised intermediaries. Yet the institutions enforcing this cap and the massive political financial flows they manage remain completely protected by intentionally unauditable allowance systems, magically missing text messages, and bureaucratic opacity. The technological capacity to completely end public corruption exists today. It works perfectly within the digital euro's proposed architecture. However, this technology is simply pointed downward at the citizen, establishing a permanent, structurally embedded system of asymmetric surveillance.
Which brings us to another massive shift.
Oh.
The move toward programmable money. I saw a story online about Markin, a small hardware store owner in Lyon, who found himself entirely at the mercy of smart money. During a severe regional economic downturn, the government activated a stimulus feature on the digital euro. So to prevent economic hoarding and force immediate liquidity into the local economy, certain digital deposits were programmed with a hard expiration date.
An expiration date on your money.
They had to be spent within 30 days, or the funds would systematically vanish from the ledger. Mark watched his customers rush to buy tools they didn't actually need, creating a false, panic-driven spike in demand that left his store shelves empty and his long-term business savings accounts completely stagnant.
And this scenario perfectly illustrates the mechanical application of forced velocity in a programmable currency environment. When a central authority dictates a timeline for capital expenditure, it overrides the natural, organic demands of the market entirely.
And the consequences for Mark went far beyond just managing inventory. When Mark tried to use his own business reserves to pay for his daughter's emergency medical tuition, he found that his specific stimulus tier euros were rigidly restricted.
Because of the categorization.
Exactly. The system dictated that they could only be spent on approved industrial supplies, specifically targeted to support the local manufacturing sector. His money was no longer a universal medium of exchange. It had become a set of conditional vouchers loaded with a highly specific political agenda.
Yeah.
Trying to imagine Mark's frustration makes you realize how much we take the fundamental neutrality of money for granted. As a commentator, I see the logic from the central bank's perspective. They want a more responsive monetary policy to prevent deep recessions. It's a social good in macroeconomic theory,
Sure.
But when you look at it through the lens of individual sovereignty, it feels like the government is reaching directly into your wallet to tell you exactly how to live your life, how to run your business, and how to care for your family. We have to be incredibly careful here. While programmable money sounds like a futuristic, frictionless efficiency, it can easily morph into a sweeping system of behavioral engineering. Yeah. We can respect the institutional intent to stabilize the broader economy while still feeling a deep, visceral discomfort with the reality that our hard-earned savings now come with terms and conditions, dynamically applied by a distant bureaucrat.
And to fully understand the mechanics behind Mark's situation, we have to detail the Euro Retail Payments Board's strict definitions and the European Central Bank's official distinctions regarding programmability. Because the ECB explicitly and repeatedly promises that the digital euro will never function as programmable money.
They are very firm on that phrase.
They define programmable money very narrowly as digital units that can only be used for buying specific types of predefined goods or services, or units that are strictly limited to a certain geographic region or time frame, essentially acting as a government-issued voucher. Their official stance is that central banks issue universal money, not restricted vouchers.
Right.
Instead, the European Central Bank offers a concept they term the programmability of payments.
And the distinction they draw is crucial to their public relations strategy. They define the programmability of payments as a purely user-centric system. It is framed as a convenient mechanism where users voluntarily authorize supervised intermediaries like commercial banks or payment apps to initiate automatic payments based entirely on user-defined preset conditions.
Like setting up an automatic, frictionless monthly transfer to pay your rent.
Exactly. That's the classic example they use.
However, unpacking the actual technical architecture reveals a profound, unresolvable contradiction between their policy promises and the technical reality they are constructing. The Euro system is actively providing and managing the deep back-end functionalities necessary to support these programmable features.
Yeah.
This infrastructure includes the complex definition of business logic, the overarching authorization protocols, the continuous algorithmic checking of transactional conditions in real time, and the final clearing and settlement instructions on the ledger. By physically building this robust conditional infrastructure at the absolute settlement layer and within the mandatory intermediary tier, the European Central Bank is establishing the exact technical capacity required for the aggressive behavioral engineering that Mark experienced.
So it's about the intent versus the capacity.
Precisely. Even if current institutional policy firmly states they will not implement programmable money, deliberately deploying the back-end technical infrastructure to reserve funds dynamically and execute complex conditional logic means the dial of control has been fully installed. The technical architecture of total economic control is completely present and operational, requiring only a future policy shift to activate it against the citizenry.
Which represents a profound historical shift for monetary tools across the entire Eurozone. I mean, traditional monetary policy relies on broad, blunt tools. Central banks adjust macro interest rates to slowly influence borrowing costs and aggregate spending across the entire economy over months or years.
Right.
By integrating the direct capacity for complex conditional logic directly into the immediate settlement layer of the currency itself, the financial system moves instantly toward targeted, hyper-granular control. It completely opens the door to activating expiration dates on individual digital deposits, enforcing automatic reservation of personal funds, and applying dynamic categorical spending restrictions in real time.
Yes.
This fundamentally alters the historical social contract of money, transforming it from a neutral, passive bearer of inherent value into an active, weaponized instrument of targeted behavioral and economic management.
And this brings us to the psychological aspect of this whole transition. Imagine a man named Thomas, a brilliant MBA graduate working as a senior analyst at a top-tier financial firm in Frankfurt. Thomas spent his entire career explaining to high-net-worth clients that commercial banks operate basically like vaults, where their hard-earned deposits are safely stored and then carefully lent out to borrowers. One evening, while attending a public transparency forum on the digital euro, he listened to a high-ranking central bank official explain a core concept.
Right.
The official stated clearly that the new digital currency wouldn't actually be backed by commercial deposits because commercial banks actually create money through the act of lending. They create it ex nihilo, out of nothing.
Yeah.
For Thomas, this wasn't just a technical update to his understanding, it was a fundamental glitch in his reality.
He realized that the public's absolute trust in the entire global financial system was built entirely on a collective, profound misunderstanding, a productive ignorance that kept the gears turning without panic. When he later looked at the digital euro interface on his smartphone, seeing his money represented as a direct, unmediated liability of the central bank rather than a deposit at his local branch, the illusion of the safe vault shattered completely. He began to fear that if the average person truly realized that modern money was just a digital ledger entry created by a keystroke rather than a physical asset sitting in a vault, the intrinsic trust required to sustain a massive, traceable, state-controlled digital currency would simply evaporate overnight. I've spent a lot of time reading about this specific knowledge gap, and Thomas's story is far more common than you'd think. It's a systemic paradox. The entire financial apparatus only works precisely as long as we don't fully understand how it's built. From a traditional or conservative viewpoint, this looks like an incredibly fragile house of cards, ready to blow over the moment the digital euro makes the magic of ex nihilo money creation too obvious to the layman. However, we have to look at this through the practical lens of modern stability. Financial illiteracy is undoubtedly a problem, yes, but is total financial enlightenment a risk the Eurozone can actually afford? If we pull back the curtain too fast, exposing the mechanics of fiat creation, we might trigger the very catastrophic bank runs and systemic panics we're trying so hard to avoid. We need to bridge this vast knowledge gap with careful education, but we also have to deeply empathize with the fear that comes when a person realizes the solid economic ground they've been standing on for their entire lives is actually just a highly complex set of digital promises managed by unseen institutions.
And the severe knowledge gap that Thomas experienced isn't just limited to the general public. It exists alarmingly at the very highest levels of global monetary governance.
Right.
I mean, consider the highly documented interaction from the World Economic Forum panel in Davos in January 2026. François Villeroy de Galhau, the governor of the Bank of France and a key influential architect shaping the digital euro framework, demonstrated a fundamental misunderstanding of the core mechanics of decentralized digital currency. During the live panel discussion, he confidently claimed that Bitcoin had an issuer responsible for its management.
And he had to be publicly corrected by the CEO of Coinbase right there on the stage.
Yeah.
The CEO had to explain the absolute basic reality that Bitcoin is a decentralized cryptographic protocol functioning with no issuer, no parent company, and no central point of control. This embarrassing incident perfectly illustrates that the profound structural ignorance regarding modern digital monetary mechanics extends directly to the elite policymakers who are actively designing the incredibly complex digital euro framework that will dictate the financial lives of hundreds of millions of people.
And this elite ignorance contrasts sharply with the public's actual perception and practical demands regarding their daily money. According to the comprehensive study on the payment attitudes of consumers in the euro area, known as the SPACE study, the general public views physical cash as absolutely vital to their existence.
Absolutely.
They value physical cash specifically for its total anonymity, the unyielding protection of their privacy from corporate and state overreach, and the tangible budget awareness it enforces through physical limitation. A staggering 37% of European consumers actively keep significant cash reserves at home, storing their wealth entirely outside the purview of the commercial banking system.
37%. Huge.
Furthermore, the study reveals that the public overwhelmingly views commercial bank money, the numbers on their banking app and central bank, money physical cash, as functionally identical in their daily lives. They do not comprehend or care to differentiate between the legal liability of a private commercial bank and the sovereign liability of the central bank.
And this fundamental systemic public misunderstanding essentially guarantees the catastrophic failure of the digital euro's proposed disintermediation and its utility as a reliable store of value.
Yeah.
A digital currency strictly capped at 3,000 euros per person is entirely stripped of one of the three fundamental macroeconomic functions of money: the capacity to act as a long-term store of value. When an institution enforces a hard-holding limit and simultaneously implements an automated waterfall mechanism that forcefully sweeps any excess funds back into a traditional commercial bank account the moment the cap is breached, they deliberately remove the primary reason a citizen would choose to hold the currency in the first place. The public cannot and will not adopt a central bank digital currency if the underlying architecture of the system forcefully prevents them from storing their accumulated wealth within it.
And this specific architectural failure is exactly why the European Consumers Organization, BEUC, issued a strict, uncompromising demand regarding the fundamental design of the digital euro.
What did they demand?
They stated unequivocally that a digital euro must be constructed as a true bearer instrument. It must function identically to digital public cash, stored locally on a physical device, completely independent of a constant internet connection, and entirely free from account-based ledger verification.
Which is the exact opposite of what the ECB wants.
Right. This public demand directly and aggressively opposes the European Central Bank's current account-based logic, which relies entirely on a centralized digital euro service platform and necessitates the continuous, unbroken tracing and monitoring of individual balances to rigidly enforce the 3,000 euro cap and the complex programmable payment conditions.
Ultimately, the root of the public's widespread, deep-seated rejection of the digital euro stems directly from these irreconcilable design choices and institutional contradictions. The exhaustive analysis clearly shows that citizens hold overwhelming negative and neutral feelings toward the implementation of the digital euro because they see absolutely no practical, tangible benefit to its introduction into their lives.
Yeah, the benefits just aren't there for the user.
Exactly. They already possess highly efficient, functional digital payment methods through private providers. Instead of seeing an innovation, they fear the total systemic disappearance of physical cash. They worry deeply about the severe financial exclusion of the elderly, the marginalized, and the technologically illiterate.
Right.
Most prominently, and perhaps most accurately, they view the digital euro not as an innovative financial tool designed for their benefit, but as an explicit highly sophisticated architecture designed for absolute state surveillance and behavioral control.
So bringing all of these highly interconnected themes together, it is evident beyond any reasonable doubt that the digital euro is not merely a convenient payment application or a benign technological upgrade to existing banking software.
Yeah.
It represents a fundamental, irreversible structural redesign of the entire European monetary landscape. By systematically integrating unyielding data traceability, deliberately dismantling the historical barrier between personal identity and private financial transactions, and establishing the exact technical back-end bedrock required for dynamic programmable restrictions, the system effectively closes the final critical loopholes of individual financial autonomy.
The quiet inversion nobody talks about is that the digital euro is not the central bank trusting the citizen with their digital money. Rather, it is the citizen being forced to place absolute, verifiable trust in a rigged, opaque system with resources that they have been conditioned to believe were theirs, cementing a reality where financial freedom is merely a setting on an institutional dial.